Good afternoon, everyone. My name is Mitchell Sneddon. I'm the Head of Portfolio Services here at InvestSMART. And today we're going to be taking a look at different managed investment structures. So what that means is if you're out there looking for a solution for someone to manage your portfolio for you or manage a portion of your funds for you, we'll be taking a look at 4 vehicles that you can do that through and the pros and cons of each. So we'll be taking a look at exchange traded funds, we'll be taking a look at managed funds, separately managed accounts, and also listed investment companies. Now, as we go along, you'll notice just below the little video box there, you'll see a little field to submit your questions. So please send through your questions and I'll do my absolute best to get through as many of those as I possibly can throughout the time that we have here. So we'll try and keep it relatively brief, maybe to 30 minutes, including the questions. So my very first slide, which is always, if you've seen any of my presentations before, the most important slide of the day, it's my disclaimer. So during this process, we'll be talking about maybe some exchange traded funds. We could talk about some specific managed funds or some specific investment products. Now, just keep in mind that this information is in general of nature, and it's not taking into your specific circumstances when it comes to giving you any form of investment advice. And that goes for the questions you ask as well. So I can't give any specific personal advice during those questions. I can only give you information that is general in nature. So just in case I get carried away, we might even pop this disclaimer screen back up again. So onto the agenda now, and I've already outlined what we're going to be talking about. So we're going to look at these 4 different types of investment structures, how they work, the pros and cons of each, and what you need to know. And this might be able to give you a bit more insight into what would work specifically for you as well. So if you're more hands-on, or if you just don't want to know about your portfolio at all, there's an approach within these 4 that should be able to suit you, no matter if you're just starting out investing or if you've been investing for a long time and you just want to take the hands off the wheel for a moment, but still have that income coming in that you require to live off. So the next slide here is actually a quote that I got from chatting with one of our analysts, and I was talking about a friend who was starting out investing who wanted to pick 1 or 2 stocks. And if you are out there selecting individual stocks, just know to yourself you are saying that you are going to outperform, you are trying to outperform the market. Okay, even without you knowing it, or you do know it, if you are out there trying to pick individual stocks, you are saying that you can outperform the market. Now, a lot of us out there don't have the time, we don't have the skill, or we don't have the will to effectively do that. A lot of the professionals can't do it on a regular basis either. So for those of you who have decided, you know what, individual stock ownership is not for me, then this is the presentation for you. So let's get into our very first one. Oh, sorry, before we do that, the reason why this presentation is important as well, if you are going out there and looking to pick managed funds or exchange traded funds or listed investment companies, just know that it's a very broad universe. There's something for everyone out there. In the managed fund space, last time I looked at Morningstar, just for a standard managed fund search that's available to us here in Australia, you're looking over 9,000 managed funds, okay? Now that's just not Australian equities, that's international equities and property, but there's 9,000 plus of them out there. So that's a pretty big starting point. Now with exchange traded funds, there's about 151, and that little space is only growing. And listed investment companies, if you've been following along with all the IPOs recently, you would see that there's been a lot of new listings in the LIC space as of the last 2 years. So our very first structure that we're going to take a look at here is managed funds. And just one quick reminder as we are going along, if you have any questions, please type them in the box below, and I'll be able to get to them after the formal part of my presentation, because your questions are the most important part of this presentation. So the managed funds, how do they work? They operate as unit trusts. So what that means is basically it is one pooled investment vehicle. So you've got one bucket of funds that a fund manager raises. So they go out there and get people to agree with their investment philosophy to put funds into that bucket. and then they use that one bucket of funds to go out there and purchase multiple shares in line with their investment philosophy. So what that means is when you're buying into that, you're actually being allocated units as a percentage of what your investment makes up of the total pool of funds. Now, so it's important to keep in mind. When you go out and buy individual stocks, you actually own the shares. You don't actually own the underlying shares in that pooled investment structure, okay? Now, the other point to keep in mind is managed funds are open-ended structures. So when people say they're open-ended, what they're saying is that money from you investors out there can flow in when you apply for units in the fund, and money can flow out when you redeem your cash and cash in your units. So cash can flow in and cash can flow out at any point in time, and that's what an open-ended structure means. Now, there's benefits and there's negatives to that process, and we'll get to those in the pros and cons. Now, a managed fund, historically, a lot of them were unlisted, so you would have to apply directly with the fund manager through a paper application form, send in your ID, etc., to be able to access and get invested in that managed fund. These days, though, there's a lot more managed funds coming on to the market. So through the ASX, you've got the ASX's M Funds program, where managed funds can list with those, and you type in their code and you're able to purchase the managed funds just like you would a stock on the stock market. There's also things called exchange quoted managed funds, where it's essentially a managed fund that's listed on the market as well, and you buy units in that fund on the market. So the reason why that's a good thing is because you don't have to go through the process of filling out a paper application form, and you don't have to go through the process again of sending in your identification documents, like going out there and getting certified ID, etc. So because you've already done that with your online broking account. If you've got a CommSec account or a NabTrade account or an E-Trade account, you've already had to go through that identification process. So you just type in the code and you're invested in the fund. It's that simple. Typically, managed funds are valued daily. So you might see the NAV, or the net asset value, of the fund, and that's calculated usually on a daily basis. If it is listed, it's calculated on a more regular basis, and that it can be calculated like, say, every 10-20 minutes if it's listed. Some funds, though, if they're say not huge funds, they can have weekly or sometimes even monthly unit pricing. And what that means to you is, if say it's weekly and it gets priced every Friday, when you go to put in funds into that particular fund, if your form is with them and the cash is cleared by that Friday, then you'll get funds that week. If not, you'll have to actually wait till the following week before you're actually allocated your units. And the same goes with redemptions. So if it's only weekly unit pricing, then you better have your form into them before the Friday, so they can then actually cash you out on that Friday. And so that's something to keep in mind when you are looking at managed funds. And typically managed funds will give you a monthly report. So they'll show you the numbers, as in the performance numbers, generally speaking, compared to their benchmark, once a month. Those reports can typically take about 2 weeks after the month end to come out. So around mid-month, you see a lot of fund manager reports come out. And so that will give you insight into the actual underlying value of the portfolio, but also it'll give you insight, hopefully, to the top 10 holdings of the fund at the time, at that month end. Okay. Now, the pros and cons of investing in a managed fund. You get instant diversification. By holding one unit in that fund, you are holding every single stock that fund manager has purchased. Okay, so you get instant diversification without having to do too much work. You get the benefit of an actual professional manager. Now, that sometimes is a benefit, sometimes it's not, depending on how good the actual manager is. But you do get the benefit of a professional manager applying their investment philosophy, one that you hopefully agree with, because if you don't, you wouldn't be there in the first place, applying that to try and reach or exceed their benchmark that they've stated. So you don't have to be making any investment decisions yourself at home. Now, you get access to a large variety of investment strategies through a managed fund as well. As I said at the start, there's about 9,000 plus managed funds available to Australian investors. And so that's a lot of different investment strategies. And a managed fund will always trade at the underlying value of the portfolio. In no circumstances will the actual dollar value of the units move above significantly or below the value of the actual underlying shareholdings. So you get the actual value in your unit price. And the managed fund does come with a bit more simplicity when it comes to tax reporting. So a managed fund will just send you out, generally speaking, a 1 or 2 page tax statement at the end of the year. They're generally pretty quick to come out as well because they're just doing the tax for one particular investment structure. Okay. Now, on the cons side, when we're looking at managed funds, it's a pooled investment, and so you do not actually own the underlying shares. Okay. And with the open-ended structure, as I said, money can flow in and money can flow out at any point in time. Now, unfortunately, with the broader public, when people feel good about investing in the market and want to give more money into the market, it's typically when a fund manager can least spend it. And so that means when stock valuations are very high, when say the share market is run and everyone's talking about it and it feels good to be invested, that's when a fund manager typically, especially if they're taking a value investing approach, cannot actually spend your money. And so they might be forced, depending on their mandate, to buy overpriced stock. Now, on the other side of it, if the market is correcting and coming down, people might not feel good about investing in the market and want to pull their funds out. So if the fund manager doesn't have enough cash to facilitate those redemption requests, then they are actually forced sellers of stock right at a specific time when they don't want to be selling. At the worst possible time, when they'd prefer to be buying, they're actually selling stock to meet those redemption requests. So that's how an open-ended structure can hurt an investor and a fund manager. Now, you cannot transfer stock in or out of this structure either, okay? So with a managed fund, it's just cash in and cash out. You don't own the underlying stocks, okay? So you cannot pick up your little parcel of stock and walk away and go somewhere else. You have to liquidate shares to go into it, and you have to liquidate shares to go out of it. So just keep that in mind. And it's not as tax efficient as, say, if you were investing yourself. In a managed fund structure, it's typically a unit trust, and all members of that trust will pay the tax. Now, if you came in, if you didn't get all the capital appreciation benefits from that managed fund, you still might be left having to pay some of the capital gains tax from the specific fund. So it's not as tax efficient as holding your own individual stocks. Things to consider when you're looking at an individual managed fund. I'm going to switch these 2 dot points around. Understand the investment strategy. It's really important that you know the investment strategy and know why you're investing with that particular manager, because you want to know why they get it right and you want to know why they get it wrong, because all investment managers will get it right and they'll all get it wrong at times as well. But you want to know why they're getting it wrong. Okay, so you can understand it and you can be comfortable with it. So that's really, really important. If you don't know how derivatives work, don't invest with a fund manager that does derivatives. Now, going back to the first dot point here that I just skipped, check for a high watermark when paying performance fees. So this is really important. I'm not against paying fees. I think funds management teams, of course, deserve to get paid their management fee, and if they perform well, they deserve to get paid a performance fee. What I am against is when teams don't have a high watermark in place. Now, what a high watermark is when you're paying your performance fee. Say, for example, performance is set at 10% per annum. The investment team actually gets 20%. You've exceeded that benchmark there by the 10%, and you pay your performance fee on top of that. Now the next year it goes back down and it goes down to where it originally started, okay? So you've given back all that 20% back to the market. The following year, you shoot up again and you do another 20%. If you don't have, and so what that gets you back to is level where you were at previously. Now, if you don't have a high watermark in place, if the fund manager does not have those words in their product disclosure statement, what will happen is you'll get charged a performance fee again for getting you back to exactly where you were. So the reason why a high watermark is important when you're reading fees is because what it means is you'll have to reach the highest point that the fund got to previously. So you have to regain all the losses, and only then when you exceed that can they actually charge you a performance fee. And that to me is fair. So now with a managed fund, beware of your income requirements. You will have to actually sell units if you require any additional income outside of their set distributions. Okay, so just keep that in mind. I know a lot of people are, they're not fans of having to sell units or sell shares to actually fund their lifestyle. But in a managed fund, if the distributions that I say take place twice a year aren't enough, you might have to do that. Now, the last point here is be comfortable with the level of visibility of the portfolio. You, generally speaking, will only ever get to see the top 10 shareholdings at the end of the month. And it's not just right at the end of the month as it stands, it's generally about 2 weeks once they've reported in the monthly update to you. So typically with a managed fund, you'll only get to see the top 10 holdings. And if they're an active manager, there's a chance that a few of those names, by the time you're looking at them, aren't even in the portfolio anymore. So just keep that in mind. You'll get to see a unit price ticking up and down, and you'll get a note at the end of the month from the manager. So you just have to be comfortable with that level of transparency. Now, moving on to our next vehicle, our next investment structure, we're going to look at separately managed accounts. Now, these take managed funds to another level. It's like your own personalized managed fund, okay? And it's the actual investment structure that we use here for the majority of our investments. Now, I wouldn't say for all of our investments because coming up we are looking to launch a couple of managed funds as well, but currently all of our investments are under the separately managed account category. So let's get into those. Now, the separately managed account is managed by a professional fund manager, okay? So it is managed to a model portfolio. So we have a specific portfolio that you said that you want to invest in, and when that portfolio changes, when the manager says it should change, your portfolio, your actual holdings will change along with it. So your shares are actually held in your own name, so you have full beneficial ownership of the underlying shares. So when I said it's like your own individually managed account, think about before with a unit trust, you're all in one bucket. Everyone here has got their own individual buckets, okay? And that way you can hold your own individual shares. And if 3 people are following one model portfolio, when the percentages change in that model portfolio, say for example we have CBA at 6% and BHP at 3%, if we change CBA from 6 to 3%, then we'll do that across all the portfolios. And so no matter if someone's got $10,000 or $10 million in theirs, they'll have the same asset allocation within those portfolios, but they're all separated. So I believe I've just actually spoken about the last other 2 dot points there as well. So that's a really big differentiator. It operates very similarly to a managed fund where a professional manager is doing it for you, but you're in your own individual account and you actually own the underlying shares, okay? Now, the pros and cons when it comes to separately managed accounts, you get 100% transparency. So that's a big one for me. You actually get to see all the trades. So every single transaction, our clients can see every single one that we do for them. You get to see all the income that comes in. So as a stock pays a dividend, you get to see that exact dividend come from that stock into your account. and you get to see all the holdings. So you see our 1% positions and you see our 8% positions. So not just the top 10, but absolutely everything in the portfolio. And so, with us as well, you do actually get to see all the logic behind the buy and sell decisions, which I think takes the separately managed accounts to a whole new level. Now, separately managed accounts as well, and this is really important to us, especially for a large portion of our demographic of investors. It's very flexible with the way you receive income. So I mentioned before, you can see the exact dividends that you receive from each company. Well, you can actually have those dividends, as they're paid at the end of the month, transferred out into an account of your choosing. So as and when the dividends are paid at the end of the month, they just get swept out, as well as any interest earned on the cash that's within your account. On top of that, you can actually have a set monthly or quarterly drawdown from your portfolio. So if you know that you need, say, $4,000 drawn down per month to fund your living expenses, then you can do that with the portfolio. You can also combine that with that monthly dividend drawdown as well. So, or you can do ad hoc payments. So you can have the dividends coming into your account, then being swept into a bank account of your choosing. And then if they fall short of the dollar value you need for the month, you can just ask for that dollar value to be transferred into your account, and we will take care of that. So the flexibility with a separately managed account, because it is your account, is really handy, and it's something that we particularly like about this structure. Greater tax efficiency, because you only pay capital gains tax on the gains you've earned, because once again you're in that separate structure, which is very handy, and they're very cost effective as well to run. So we can keep the fees at a really good level. For example, our InvestSMART diversified portfolios start at 0.77% per annum, and they go down. And our actively managed intelligent investor portfolios start at 0.97% per annum and then go down as well. So if you are out there comparing it to managed fund pricing, then you will know that a lot of managed funds are typically 1.2, 1.5% plus performance. Ours start at a maximum of 0.97 and go down, and there is no performance fee. So onto the cons of these separately managed accounts. You cannot exclude specific stocks. So if it's in the model, it's in your portfolio. Some people might not want to hold BHP, etc. But if it's in the model portfolio that you've selected, you will hold it to the specific weight. We can't isolate individual shares and not have them in your portfolio for you. Now, the other con is, yes, it is less paperwork than holding individual shares when it comes to tax time, but it's slightly more paperwork than, say, compared to a managed fund. So with that added flexibility and transparency and greater tax efficiency and cost effectiveness, you do get a little bit more paper at the end of the year to give to your accountant. But once, as I said, it's less than your individual shareholdings if you held a portfolio of 20 stocks yourself, but it's more than a 1 or 2 page managed fund tax statement. Things to consider when investing in a separately managed account. Does your SMA allow you to invest in multiple models in the one account? So a separately managed account is your little platform to go out there and handpick different models. So you have the one account and you can invest in a range of different models. With ourselves, we've got approximately 7 at the moment that you can invest in, and you can mix and match and blend those 7 portfolios together to create your own specific mix. So have a look out there. There's a lot of people that do provide separately managed accounts. Typically they are on investment platforms. And when I say platforms, I mean like the likes of, say, a BT Wrap or a Macquarie Wrap or etc. So we offer it direct to our investors, but most managers will go through an actual wrap platform. Now, with that comes another layer of fees. You will be paying platform fees, so just keep that in mind. as well when you're looking to invest in a separately managed account. If you go direct to the manager and they offer it directly, as we do, you avoid that. But if you go onto a platform, you're having to pay the platform fees plus then the management fees of the individual models that you select. Of course, keep a close eye on those management fees that you're paying. And as I said previously, with a managed fund, keep an eye, if you are paying performance fees, make sure those words high watermark are in place in the product disclosure statement so you're not paying twice. Now, moving on to exchange traded funds. These have been picking up a lot of speed and popularity recently. So basically what an ETF is that they are an index tracker. Now, that can be one of two things. It can be an already existing index like the S&P ASX 200, or it can be an index of the actual issuer. So that's that could be a bank, or it could be State Street, or Beta Shares, or iShares here in Australia. And they can create a specific index to a specific set of rules that ETF will then follow. So you just have to be aware that if you're tracking an index that already exists, like say a commodity, for example, or the ASX 200, or if it's one of the issuers creating. And so these are similar to a managed fund. They are like a unit trust. You buy into them and out of them on the ASX. The exchange traded fund is just an exchange traded product. They can use many different investment strategies. So just because it's an ETF does not always mean that it's going to track a basic index. They can create an index out of using one rule or two rules or a whole stack of rules to create that specific index that ETF will then follow. So those rules will then be based around different investment strategies and desired outcomes. So just keep that in mind. Just because it's labeled an ETF doesn't mean it's just tracking a standardized benchmark. So when it comes to ETFs, there are market makers who buy and sell units to create the liquidity in the exchange traded fund. And typically with an exchange traded fund, especially in our Australian market, where at the lower end of the market liquidity can be a little bit rare, you're going to be looking at ASX, say top ASX 300 companies in these ETFs. The reason for that is because the underlying fund actually needs to go out there and buy stock in the companies that it holds. So there has to be someone there creating the liquidity and buying and selling units to the investors as they come and go from the fund. Pros and cons with ETF investing, it is instant diversification. So when you are investing in the market, if you're handpicking individual stocks, you're taking on two main items of risk. One, you're taking on market risk. Secondly, you're taking on company-specific risk. With investing in an ETF, especially something like, say, the ASX 200, you're taking away one of those. You're investing in 200 companies, so you're taking away company risk and you're just exposing yourself to market risk. So you get instant diversification through using these. Now they are low cost. You get low cost access to these markets, and you get low cost access to global markets as well. Historically, it was always maybe a bit difficult for us as Australians to invest around the globe. Now with ETFs, you can buy one stock and then you've got instant diversification around the world, which is pretty handy. You can also invest in very specific themes with ETFs. I mentioned commodities before, so if you've got a view on the Australian dollar, if you've got a view on the gold price, you can invest in an ETF to take advantage of that. If you, for example, want to invest in global healthcare, there's a global healthcare ETF out there that you can invest in. If you want to invest in global cybersecurity companies, there is an ETF out there that you can invest in. So you can actually invest in very specific thematics, and that's why ETFs are very handy. And you can also create low-cost multi-asset class portfolios using ETFs. So if you know you want to be broadly diversified, you can actually go out there and buy a handful of ETFs, and without holding too many stocks, you can have instant diversification across sectors, regions, and asset classes. And that's exactly what we've done with our InvestSMART diversified portfolios. You might have seen on the website, we've got our InvestSMART core growth portfolio, and we've got our InvestSMART diversified income portfolio. We're using exchange traded funds there to invest in a range of different asset classes at a cost-effective level for our investors. Now, the cons of ETF investing, because they track an index, they will always underperform that index, even if it is one of their own creating, by the level of their fees. So say, for example, if an ETF tracks the ASX 200 and it charges 0.19% per annum, a minuscule fee, it will underperform the ASX 200, all things being equal, by 0.19% per annum. Okay, just keep in mind that there is no circumstances where you can invest in an ETF and actually outperform your index. It just won't happen. They're not designed to do that. And of course, you will hold the good, the bad, and the ugly. When you go out and buy the ASX 200 ETF, you will hold all 200 companies. And there could be some companies in there that you certainly don't want to hold, but you'll have to hold them anyway because they're all packaged up in that exchange traded fund. Okay. Now, things to consider when buying, when we're looking at ETFs to bring into our diversified portfolios, what we're looking for are very simple when it comes to the big index tracking ones. We focus on fees and the size. Okay, so the bigger it is, the less issue we have with tracking error, and of course the less the fees, then the less the difference between the benchmark and the actual performance of the fund. So of course, they're our two main focus, the cheapest and the biggest. That is all we want when it comes to a plain old index tracker. Now, be mindful of smart beta. There's a lot of smart beta exchange traded funds coming up. These are essentially actively managed portfolios. They might not have a fund manager buying and selling stock with a philosophy in the background as they go along, but what they actually do have are a set of rules that they've put in place and that they'll follow. Now, there's two good things about having a rules-based one good thing and one negative thing about rules-based investing. The positive is you have to follow the rules. The negative is you have to follow the rules. So, and also a lot of these rules, it's based on like the current reporting from the companies. So it's always backward looking. So for us, when we're looking at investing in ETFs, we're doing it for a passive investment and we're looking to get that index return. So it's always those passive ETFs that we're after. Once we go into the area of having different rules around what the holdings, then to us it's coming into more active management. And if we're going to do that, then we've got our own our intelligent investor analyst team. It's got a pretty good track record of selecting stocks when it comes to that. Now, listed investment companies, and this is our last investment structure before I then get into answering your questions. I haven't seen the questions coming through because I've got my presentation up at the moment, but I'm sure there's heaps of them there. Listed investment companies. Now, if you cast your mind back to when we're talking about managed funds, we spoke about them being open-ended structures. Well, the word company in this means the opposite. These are closed-ended structures. So once you go out and raise money, if you participate in an LIC IPO, initial public offering, they're raising that money, and once it's there, it's locked in. So you as an investor, the only way you can get your funds out are to sell them on the market to other investors. Okay, and of course the closed-ended nature of that vehicle, just like the open-ended structure, has benefits and also has negatives, and we'll get into those in the pros and cons. So as I mentioned, you buy and sell LICs on the market, or of course you can participate in their IPOs or capital raisings. They can trade above or below the actual real value of the portfolio, and that's been a big positive and also a big deterrent for a lot of people when it comes to investing in listed investment companies. So we'll go into that in the pros and cons as well. And they can be internally managed or they can be externally managed. Now, internally managed, that portfolio has embedded in it its own analyst team running it. Externally managed means you've raised a bucket of capital and you get an external team, so another company that will actually manage that and charge a management fee to the portfolio. Now, if you go back 20 years, the most common one here was internally managed. That's the likes of Australian Foundation Investment Company and Argo. Jump forward to where we are today. Now, by far the most commonly managed, common structure here is externally managed, where you typically will actually have the manager that's called the same funds management name as the LIC, and they're managing the portfolio. So the most common one known today is Wilson Asset Management. There's the Wilson Asset Management Company, manages I think 5 LICs at the moment. They're all called Wilson such and such, depending on what they're actually trying to achieve within that individual portfolio. So typically those externally managed will have higher fees and costs associated with them than those internally managed. So just keep that in mind. What I've put here is focus also on total shareholder return. Just performance numbers, and the performance numbers managers choose to use to show you are marketing tools. Of course, yes, it's what the portfolio has achieved, but of course they'll pick the numbers to show you for marketing purposes, of course. If you are investing in listed investment companies, what you actually generally care about is the total shareholder return, commonly abbreviated to TSR. So what that is the total dollar value in capital growth, that's from where you buy the LIC to where it is currently, plus any dividends paid for you. So that is what I really focus on when looking at these. So the pros and cons. The first point here, I've got the portfolio can be positioned with a true long-term view in mind. Now, what that means is I'm thinking back to the closed-ended structure. Because money can't go out, because it's a locked-in pool of capital, that manager can really focus on the long-term investment horizon, and they can actually position that portfolio truly with the next 3 to 4 to 5 years in mind, without having to worry about investors getting impatient and redeeming their funds within 6 months. Now, there are numerous investment strategies in the LIC world. As I said at the start, there's about 90 of them, so there's plenty of different strategies out there for you. They can trade at a discount and a premium to the actual underlying value of the net tangible assets. That's how you value a listed investment company. Now, the reason why that's a pro is because that gives you an opportunity to buy it for less than what it's worth, and then sell it for more than what it's worth. So it's like, say, buying $1 for 80 cents and then selling it for $1.20. However, it's not always that cut and dry, and it's not always that easy. So for listed investment companies can trade at a discount for a very long time, and they can sometimes not even ever close that gap to NTA. Or inversely, they can trade at a premium for a very long time, and you might never be able to justify yourself buying that particular LIC. You don't want to pay $1.30 for $1. Now, the other pro I've got listed here, the company structure allows LICs to smooth out the dividend returns. Now, with a managed fund, they have to pay out all dividends, okay? So all dividends as they come in, each year they'll be paid out to members of that fund. Now, with a listed investment company, because it's a company structure, it can actually retain earnings and look to pay them out over a period of time. So you've probably seen the likes of BKI, AFIC, Argo, Milton, etc., those old LICs that have been around for a long time. You see them come through the GFC, and they're able to actually maintain their dividend payout ratio and not drop the cents per share they were paying, even through the most tumultuous time that we've seen in the last few years. And then they're able to continue then increasing the dividend afterwards. That's because they've got big pockets of dividend reserves. So that's something to keep an eye on when you are investing in an LIC. Now, the cons to investing in an LIC, the closed-ended structure can actually act as a disincentive to the manager. Now, basically, if you're a fund manager and you've raised capital, or you've put a lot of marketing effort into the raising of that capital, once you've got it, it's not going anywhere. So perhaps your incentive to communicate effectively and openly and clearly with the market isn't as strong anymore. And so what that can actually hurt is the closeness with which the underlying value of the portfolio, the NTA and the share price are trading. So that's something to just be aware of. And the fees can be high and not quite transparent. Every single LIC manager, especially the external ones, will tell you their management fee and the performance fee. But what you have to keep in mind is there's also expenses. You're paying the expenses. You're paying the directors' fees because there's a board of directors associated with these companies. And so once you add them all up, the expenses, the management fee, the performance fee, fees on this can be quite high. It's not unusual if they're charging you a performance fee plus the expenses and the management fee for an LIC's management expense ratio to be operating at around 4% if they're of course charging you a performance fee. So just keep an eye out on that. How you can check that of course is in the annual and half-yearly reports, and it's something that I know I look at quite closely. Now, the big con when it comes to these as well is the fact that they are quite small and levels of liquidity are really low. So that means how many shares are traded per day. So if you want to buy a big parcel of these, if you want to get a couple of 100,000 shares in a listed investment company, you might be waiting a few days to be able to get it at the price that you want. And so the issue of liquidity, maybe not be, you could be patient when you're going in. I can tell you what, if a lot of people are trying to get out at the same time, they become very impatient. So that's probably the biggest downside to a lot of these is the liquidity. And the liquidity compared to normal stocks really is not there with listed investment companies, and that's something you need to keep in mind. So when considering investing in these listed investment companies, once again, just like a fund manager, select an investment approach you're comfortable with. Buy at a discount to the net tangible assets. Okay, this will vary depending on fees. Now, why I say that is the less fees they charge, like an internally managed LIC, well, you don't have to buy at as big a discount as an externally managed listed investment company. If it's externally managed, depending on the management fee, you're looking for a 10% discount to net tangible assets. It can be a lot less when you're looking at an internally managed listed investment company. Be mindful of options. So a lot of LICs will list and have a bonus option attached to it. Those options can be a bit of a drag on the share price for the first couple of years whilst they're still in play. And also just check, are the actual investment managers, those managing the portfolio, are they invested alongside you? At the end of every year, you get to see the top 20 shareholders in a listed investment company. Hopefully your management team is in there with you. And dividend reserves, keep in mind, how deep are they? Once again, in the half-yearly and annual reports, you'll actually go in there and be able to see those in the retained earnings. The retained earnings will give you a bit of an indication, not a very clear one, but a bit of an indication of how deep the dividend pool is there going forward for the listed investment company. Now, I do believe that brings me to the end of the formal part of this webcast. Now, I'm going to exit my presentation here, and I'm going to go to the questions and do my absolute best to answer them all. So I'll go up to the very top here, and I've got one from Stuart. And Stuart says, are self-funding installment warrants a good way to go? I am going to demonstrate one of my points here when it comes to selecting, say, a managed fund or a managed investment, and invest in what you know and what you're comfortable with. Stuart, I know what self-funding installment warrants are. I've never used them myself. I've never been involved in a company or an organization that has. And so unfortunately, I really can't answer that. I can maybe ask around the team and find out for you, but it's not my area of expertise. Gordon has asked, income funds are generally used by investors who rely on the income. What risk assessments of your income funds do you undertake? What risk assessments? Well, I mean, we've got a couple of different income funds. If you're talking about our specific ones here, Gordon, we've got a couple of different income funds that are made up, structured differently. And so with our InvestSMART diversified income products, we're actually looking at getting a diversified portfolio across a range of different asset classes. And so what we're doing there is using exchange traded funds, and we're taking away individual company risk when investing in those. And so as well, by investing in bonds and cash and property and equities, we're not just taking on the risk of one specific asset class, and then we'll also rebalance those portfolios as well. So we're taking away the risk associated with just one asset class. We're also taking away the company-specific risk when it comes to the market through investing in those. Now, on the other side of things, we've got our Intelligent Investor Equity Income portfolio, which is very popular with our investors. Now, that is 100% Australian equity stocks, and the guys, when they're selecting the stocks to go into that portfolio, are going through their standard risk assessments of those individual companies. So you need to be aware, if you're going to invest in the Intelligent Investor Equity Income portfolio, it is 100% equity. We are hand-picking individual stocks. So we're going, say, 20 to 25 individual stocks. And with those, we are taking on company-specific risk and also market risk. So that's just something you need to be aware of. Nicole asks, I'm hoping you can effectively tell me the difference between managed funds and LICs. I just don't understand the difference. I hope I've achieved that. That was the goal. Now, Nicole, if I haven't, please send through a message in the question field. We won't publish it, but send through with your email address and I can get in contact with you afterwards, and maybe we can go over it again. That's no problems at all. Kevin asks, what are the best ones? It depends on your specific circumstances, Kevin. Some people will want to hold listed investment companies because they will still want to hold those individual stocks and have control over that, whereas others are happy to hand it across to a fund manager or a separately managed account, for example, because the separately managed account might have the flexibility that they require in their specific stage of life. Say, for example, I myself could just happily hold a handful of individual stocks because I don't really have, or a managed fund, because I don't need the full flexibility of an income, different income strategies, because I'm employed, I'm not retired yet, etc. So I don't rely on that portfolio for a day-to-day income. If I did rely on day-to-day income, perhaps I'd be looking for something that had more flexibility. So Kevin, I'm not sure if I answered your question there of what the best ones are, but once again, if you are still watching, send through your email address in the question field, and maybe I can get back to you. Let me see. Nicole says, I'm also interested in you explaining the difference between the fee structures between managed funds and LICs. Nicole, the difference between the fee structures of LICs and managed funds, well, there's not too many different differences. Managed funds will state their management fee and whether or not they have a performance fee or not, and the benchmark that they must meet for that performance fee. A listed investment company will state their management fee and their performance fee and the benchmark that they need to meet to reach that performance fee. So depending on the individual manager, they'll have different benchmarks and what they're trying to achieve. And also, so you have to look at the product disclosure statement for a managed fund or the prospectus for a listed investment company to see the finer detail there. With both a managed fund and a listed investment company, you're going to be actually paying the expenses associated with it. So just keep in mind that. So you can actually calculate the management expense ratio with a listed investment company from their annual and half-yearly reports. Managed funds have to put out an annual report as well. You can calculate the management expense ratio from there as well. So you'll have to pay either way. Nicole also asked, can we get a copy of the slides? Absolutely. Send me your email address through the question section here. I won't publish it, of course, and then we can send you the slides. And everyone who registered as well, I'll make sure you also get a copy of the slides. Let me see. Daryl says, how many analysts do you have in your portfolio team? How does it compare to your competitors? That's a tough one to answer. I can tell you how many we have. We have, off the top of my head, I think it's seven or eight analysts internally within InvestSMART and Intelligent Investor. How we compare to our competitors? Well, from the ones that I know, we actually probably have a larger analyst team than the majority of ones that I personally know. There are some LICs out there where it's just one or two people selecting stocks to go in them, and as far as fund managers go as well, they can just be a team of one or two. But then you can get a team of, some of the large ones, you can get a team of 20. Doesn't necessarily make it a better, more effective management team. Maybe, maybe not. Maybe there's a saying, too many chefs. But we're very happy with the amount of analysts we have here.